The night Rome froze its banks. It started without warning, in the hours when the city sleeps and decisions carry the most weight. Phones rang behind closed doors, lights flicker on inside ministries, and a single realization spread with chilling speed. By morning, Rome would have to do something it had never admitted was possible. To understand why Italy reached the brink of freezing its own banking system, we must return to a moment when confidence mattered more than numbers. Italy's banks were woven into daily life, financing businesses, households, and the state itself. For years, the system survived on trust layered over complexity, supported by tradition and the belief that stability could always be negotiated. That belief still echoes today, whenever markets assume tomorrow will resemble yesterday. The story begins with a familiar imbalance. Banks held vast amounts of government debt, while the government relied on banks to fund itself cheaply. As long as markets believed in Italy's solvency, the cycle held. But confidence is not a permanent asset. It shifts quietly, responding to rumors, data releases, and political signals that rarely arrive all at once. In Rome, those signals began to align in unsettling ways. Late in the evening, reports reached regulators showing an acceleration they could no longer dismiss. Deposits were moving, not in panic, but with intent. Large institutional clients were shifting funds abroad. Interbank lending tightened within hours. Yields climbed just enough to signal danger without triggering headlines. To outsiders, the system looked intact. Inside, it felt hollowing. Officials traced the movements back through clearing systems and payment networks, discovering that liquidity was evaporating faster than expected. A slow-motion run was underway, invisible to the public, but unmistakable to those watching the flows. Each transfer weakened the system's ability to open normally the next morning. The question was no longer theoretical. It was immediate. Inside emergency rooms, advisors confronted an impossible choice: allow banks to open and risk a cascade they could not stop, or halt the system long enough to contain the damage. Freezing banks was unthinkable, yet letting confidence collapse was worse. Italy stood at a threshold where every option carried consequences far beyond its borders. As midnight passed, the final calculations were made. What unfolded next would redefine how Europe understood financial control, sovereignty, and the thin line between stability and suspension. And when Rome made its choice, the rest of the continent would feel the tremor. As the night deepened, the data grew more troubling. Payment systems showed abnormal clustering, transfers moving through specific corridors rather than dispersing naturally. It was not chaos. It was strategy. Those with the most information were exiting first, quietly, efficiently, without triggering alarms meant for sudden panic. That pattern frightened regulators more than a visible run ever could. Inside the central bank, teams mapped liquidity hour by hour. The projections shifted with every update, each curve steeper than the last. What they saw was not a single failing institution, but a network under synchronized stress. Smaller banks depended on overnight funding that was already thinning. Larger banks leaned on collateral whose value hinged on market confidence that was slipping away. The system remained standing, but only because nothing had pushed it yet. Ministers joined the discussions as legal boundaries blurred. Freezing banks was not just a financial act. It was a political shockwave. Payrolls would stall. Businesses would pause. Citizens would wake to uncertainty. Yet opening as normal carried a risk that could spiral beyond containment, draining reserves in hours and forcing international intervention before Italy could even frame the narrative. Behind the arguments lay a deeper fear. Italy's banks were not isolated. They were threaded through Europe's payment infrastructure, clearing transactions for companies and governments far beyond its borders. A disorderly collapse would not stop at Rome. It would ripple through Frankfurt, Paris, and Madrid before markets could even react. Containment required speed, not consensus. Legal advisors outlined emergency powers rarely spoken aloud. Temporary suspensions, coordinated messaging, capital controls disguised as safeguards. Each measure carried precedent, and precedent carried memory. Once taken, these steps could never be unseen. But the alternative was to gamble that trust would hold until morning, even as evidence suggested it would not. Meanwhile, international desks noticed the silence. Overnight lending desks reported reluctance, then refusal. Counterparties demanded higher margins. Some simply stopped answering calls. The global system, sensitive to hesitation, began closing its doors one by one. Italy was running out of time to decide while it still had agency. As dawn approached, the final assessments arrived. If banks opened unrestricted, outflows could overwhelm defenses before noon. If operations paused, damage could be localized, explained, managed. It would be a shock, but a controlled one. The choice narrowed: control now, or chaos later. In the quiet before sunrise, a decision crystallized. Italy would intervene at the system level, not to punish failure, but to stop acceleration. The freeze would be framed as protection, not collapse. And with that decision, Rome crossed a line few modern governments had ever dared to approach. What followed would test not only Italy's institutions, but Europe's tolerance for emergency power exercise in silence. The moment the order was finalized, coordination replaced debate. Instructions moved through encrypted channels, reaching bank executives, clearinghouses, and payment operators almost simultaneously. Timers were set, safeguards activated. Systems designed for speed were now repurposed for restraint. The architecture of modern finance, built to move money instantly, was being asked to do the opposite. Inside major banks, senior staff were summoned before sunrise. Access privileges were adjusted. Large transfers queued but did not execute. Branch managers received carefully worded notices that avoided the word freeze entirely. Everything hinged on language. Panic could not be allowed to outrun policy. The public narrative had to arrive after the mechanism was already in place. As European markets prepared to open, subtle distortions appeared. Settlement confirmations lagged. Cross-border payments paused in review states longer than usual. Institutional traders noticed immediately. Screens showed nothing dramatic, yet execution felt thick, resistant, as if the system itself was hesitating. That hesitation carried meaning. Something extraordinary was happening in Rome. In Brussels and Frankfurt, emergency calls lit up secure lines. Italy briefed key counterparts minutes before the first public signals emerged. The message was blunt but controlled. Liquidity stress had reached a point requiring temporary containment. There would be no disorderly failure, no unilateral defaults, but movement would be limited until stability returned. The reassurance mattered, but it did not erase concern. Europe had built its financial identity on uninterrupted flow. A pause, even a justified one, challenged that assumption. Markets reacted not with panic, but with calculation. Bond yields adjusted upward, then steadied. Bank shares dipped, then hovered. Investors waited, measuring whether this was a momentary intervention or the opening of something larger. Silence from Rome became as powerful as any announcement. In the absence of noise, speculation filled the gap. Inside Italy, businesses felt the effects almost immediately. Large transactions stalled. Treasury departments delayed payments. Corporate accountants recalculated cash positions with urgency. For households, the impact was quieter but no less real. Access remained, but limits appeared where none had existed before. The message was implicit. Normality was temporarily suspended in service of survival. Behind the scenes, regulators monitored flows with relentless focus. The freeze slowed the run, but also exposed where pressure remained strongest. Certain corridors continued to strain, revealing dependencies that had been underestimated for years. The intervention had not solved the problem. It had bought time, and time in finance is only valuable if it is used. As hours passed, one reality became clear to everyone involved. Italy had not merely frozen its banks. It had forced Europe to confront a question long deferred. In a union built on free movement of capital, who decides when movement becomes dangerous? The answer, still forming, would reshape how the continent understood control, coordination, and the limits of trust in a system that never sleeps. By midday, the freeze had done what hours of reassurance never could. The outflow slowed. The silent run lost momentum. Systems that had been draining liquidity now held steady, not because confidence had returned, but because motion itself had been restrained. Italy had forced the financial system to pause long enough for reality to catch up with fear. Behind the scenes, emergency negotiations moved quickly. Regulators worked with banks to assess capital gaps exposed by the freeze. Weak points were identified with brutal clarity. Institutions once assumed resilient now revealed dependency on overnight trust rather than durable balance. The intervention stripped away comfort and replaced it with facts. Some banks would need support. Others would need restructuring. All would need credibility rebuilt. Europe watched closely. The freeze had not triggered collapse, but it had shattered an assumption that had guided policy for decades. That modern financial systems could always absorb stress through speed, liquidity, and coordination. Italy demonstrated the opposite. Sometimes speed amplifies danger. Sometimes liquidity accelerates collapse. And sometimes coordination requires stopping movement, not encouraging it. As statements were released, language was chosen with surgical care. This was not a shutdown. It was a safeguard, not a failure, but a stabilization. Markets responded cautiously, recalibrating rather than fleeing. Bond spreads narrowed. Payment corridors reopened selectively. The system began moving again, slower and more deliberately than before. Inside Italy, the psychological shift was profound. Citizens realized how close the system had come to slipping beyond control. Businesses reassessed assumptions they had never questioned. Policymakers understood that trust, once fractured, cannot be commanded back into existence. It must be rebuilt through transparency, discipline, and limits that are acknowledged before crisis arrives. The freeze ended quietly without celebration. Normal operations resumed, but nothing felt normal anymore. A line had been crossed, and Europe would remember it. The precedent was now real. In moments of silent acceleration, governments could intervene not after panic erupted, but before it became visible. The night Rome froze, its banks became more than a crisis response. It became a warning etched into Europe's financial memory. Stability is not the absence of movement. It is the ability to stop when movement becomes dangerous. Subscribe to join the journey. The night